The bank is going to become the gatekeeper again for DeFi protocols then.
We want the two systems to coexist. So if you live in a country where there's, let's say, a dictator and he's freezing your bank account, it's good to have an alternative, which is crypto. And likewise, if people that are running crypto start to do stupid decisions, then it's good to have a competition from the traditional financial world. Maybe they are faster, they are more trustworthy, they are easier to use. That is the standard that we need to beat if you want to convert people from one to another.
Marcos Viriato and Alex Buello are the co-founders of Rails. Rails is a blockchain infrastructure platform that lets banks issue, manage, and transfer digital assets on public chains with built-in KYC and compliance.
We are dealing with some banks that are planning to launch their own stablecoins and process payments. Yesterday, we had a call with a bank that say, oh, if we can use your attestation service on the public chain to verify the recipient of the account before sending the stablecoins, that's perfect. And that's exactly what we're building.
Alex and Marcos, welcome to Alpha Nash.
Hi, nice to be here. Thank you.
My pleasure to be here.
You have the vision of bringing over $100 trillion to on chain. So can we dive into that straight away?
The way we see is that financial markets has been isolated from DeFi for a long time for the various reasons, compliance concerns, risk of, not dealing with identified wallets, know your transaction and so on. How come, a financial institution with like 100 million customers, 60 million customers could use a public blockchain without some regulatory controls? The way we see, we're creating primitives that brings compliance, brings security, and bring the ability for a bank to provide on-chain banking services, from being part of a lending pool, being part of being a market maker into an FX AMM, where you could convert seamlessly a non-US dollar stablecoin to a US dollar stablecoin or any currency, as a matter of fact. So that's what we're building. So this would allow banks to bring their liquidity and this $100 trillion on chain.
All right. So that's Marcos, co-founder and CEO. Now, Alex, as CTO and co-founder, what's your take on that?
I mean, it's pretty much what Marco said. The thing is, we are trying to kind of bring all the liquidity from traditional financial institutions onto blockchain. I've been in blockchain for 12 years now in crypto. Was an early Bitcoin miner, and I've been seeing that there's a lot of growth that happened. There's a lot of users, but if you look at how many users there are in blockchain crypto overall, maybe a few dozens of millions, maybe a couple of hundred millions, depends who you ask, but the thing is, banks overall and traditional financial system, they have 5 to 6 billion clients, so it's another order of magnitude. And the same goes for the liquidity, all this money. And so basically what we have set out to do when we got together, Marcos and I, a long time ago, to build a company, is that we want to merge those two worlds, and bring this liquidity, to on chain, and also bring the younger generation that is very used to using blockchain onto this merge with the traditional financial system.
That's a very sort of ambitious, bold vision to get the whole of the banking world on chain, and I can see where it's coming from. Um, and by the way, this is the first time on my podcast on Ash. I'm having two co-founders together, which is amazing to have both of you, and especially the roles that you essay. Now, before we dive in sort of further into that vision, and how that can translate into an actual executable plan on chain. um, you founded Parfins and Rails in Brazil several years back. Can you walk me through how you guys went about it? How did you meet? What was the sort of and what Parfin is and what Rails is? How it is structured. Just an overview of all of that, just to set things in context. And yeah, maybe Marcos, you could go first, and then Alex.
Yeah, we met in 2019 in London. I was living there, and the view was to, I'm coming from financial markets, and I said, well, banks and financial institutions will embrace blockchain, but there's a lack of technology infrastructure that would allow them to do this. So with that in mind, and when we catch up with Alex, we met there, and we said, oh, uh, let's test the waters and see if that there's a demand for what we built. We built some screens, it was quite funny. We built some screens of a platform, that we built, and we showed some clients, and they said, wow, if you have that, I would use it. So it was very mock-up, system, and then we start building. And later in 2020, we got the first client to use this, what we call today the Parfin platform, which is a brokered system that banks can offer digital assets to their clients, starting with crypto. And the pandemic came at that year, and I moved back to Brazil. And Brazil has a very open regulatory framework with the central bank pushing the usage of blockchain and the Securities Commission. With that, we managed to get this platform in the largest bank in the country. So we have like banks like Santander, Bradesco, Santander with 65 million customers, Bradesco with 90 million customers, Inter with 30 million customers, and so on. So we managed to get into those banks so they could offer stablecoin and crypto to their clients. Some of them said, I want to start tokenizing assets. And we said, well, but we help you. But they said, well, but we want to do firstly internally. Then we start designing Rails as it is today. So with this initial version of the Rails subnet or Rails private node, which would allow a financial institution to tokenize for their 65 million customers, like 1.2, 1.3 million certificate of deposit a day. But if they have those Rails nodes in an isolated way, that wouldn't mean anything. Then we came with the view to launch the public chain, which would be the liquidity aggregation. So that's how we started. We had a product that would allow initially banks to offer crypto and stable coins and tokenize us to their clients. And then that demand generated, that generated the demand for I want to tokenize, but in a secure way. So from the bottom up, we understood the requirements of those banks and financial institutions, and we managed to build Rails. So Parfin had this initial product and was the core contributor to build Rails. And Rails, again, has its foundation and will hopefully in the coming years will be more and more decentralized with the governance and the community helping us to shape up this future. But initially, Parfin start contributing, and as a matter of fact, the two products are kind of cohesive, but they're complementary. But Rails is much broader. Rails is a global product, it's large scale, and so we're super excited with this deal because we deeply understood the bank's what needs and requirements, and we are building a product to fit that needs and requirements to solve their problems. So that's how we started. Kind of, we started with, we call it the Trojan horse. The platform is a Trojan horse because when we are in the bank and they start, oh, I want to use Rails because I feel confident it's compliant to what I need. And again, that's where the angle we have, approached for Rails.
Okay, all right. Okay, I understand Parfin and as platform, Rails as the sort of infrastructure, a blockchain, in fact. So, Alex, why do we need another blockchain for banks to tokenize their assets?
Yeah, so one thing that we noticed, like just following up from the story that Marcos was explaining, so we got together in London. The company was built and started in London, and as during this journey of launching the first product, we started talking to lots of major banks, like large financial institutions, central banks, and some of the ones that Marcos mentioned, but also not just in Latin America, but also large banks outside, like Citibank, JP Morgan, um, Santander in Spain. So many, large financial institutions. And one of the things we realized is when we started the company, the mission was to enable financial institutions to use blockchain. And one of the things we realized is, okay, we have built one product that enables them to kind of sell and brokerage crypto to their end users, but to for them to really adopt blockchain, there are some pieces missing, and specifically the solutions that existed before Rails, they had some parts of the puzzle, but they weren't enough to make banks really want to use it. For example, you had, if you were a bank, you had to choose between using a permission system, like for example, Go Quorum or Hyperledger Besu. There's a few. But then the problem is, okay, you install those things, but then they don't communicate with anything else. You create an isolated island. So lots of financial institutions and banks, they had projects to use these systems internally, but eventually they would stop using it because it was more kind of like a POC, something to learn, and then they would stop using it. And then on the other hand, you had the public blockchains like Ethereum, Solana, and so on. But the problem is that the accounts are anonymous. There's no compliance. There's you don't know where the funds are coming from. There could be hacks. There could be stolen funds. You don't have KYC. You don't know who you're dealing with. So too many problems. And so what you saw was, okay, some banks, they would maybe try something as a test, as a pilot, but they weren't taking it seriously. And so what we have decided to do is to build a system that can bridge those two worlds, a permission chain also a public chain, but in a way that allows the financial institutions to really use the system. Okay, and so this is what we have built. We've built a system that has, on the permission side, everything is EVM, so it's compatible with the Ethereum, standards, and it's super scalable and fast, so it can reach 10,000 transactions per second. It's simple to install. The architecture of the system is one that people that work in banks, they are used to. So we did that, and then we connected it natively to the public chain of Rails, which again is EVM compatible, is a layer 2 of Ethereum. But the public chain of Rails, and this is very crucial, it has built-in KYC. So all the accounts in the Rails public chain, they are KYC. Then we take a kind of a novel approach to do that. And so we believe that this system, it fills all the requirements that financial institutions have to be really able to finally use blockchain the way that it was intended to be used.
Okay, let's just dig into that a little bit more. So there's the public chain layer, which where the compliance is built in terms of KYC, and what else?
Yeah, so what we've done in the public chain is it's a public chain like Ethereum, let's say, but the difference is that all the accounts have been KYC'd, and the way they have been KYC'd is that the accounts are linked to a bank account.
Mm-hmm.
So everyone that is using Rails, you know that there's a link with a
So
bank account. And
you
if
need
you
a bank account to sort of
Absolutely.
open a wallet.
Yeah,
Create
and going back to what I said before, right? So there's 5 to 6 billion clients of banks around the world,
Mm.
and and way more than there are people using blockchain. And so the requirement is you need to have a KYC, you have to have a bank account. It doesn't mean that in the future we cannot open new ways for people to prove that they have KYC, because there are some people that are unbanked in the world, right? But initially, our proposal here is for the banks to choose to use Rails instead of using, say, for example, pure Ethereum. We are part of the Ethereum ecosystem, but we
Mm.
believe that Rails offers much more security, compliance. Like, for example, when BlackRock launched their fund on Ethereum, a couple of hours later, someone dusted. So dusted means someone sent a small amount of funds from an anonymous account in Ethereum to the main account of BlackRock. And so this creates two problems. One problem is an accounting problem because there's more money in the account than there should be, although it's a little bit. But the second problem is that those funds, they had gone through Tornado Cash, which at the time it was sanctioned by the U.S. government. So now BlackRock, compliance department is involved because now they have to explain what happened, how did these funds end up there. So these kind of things are things that in the Rails system it would not happen, because the only reason this can happen in Ethereum is because not all the accounts are KYC'd. So
Mm.
someone can have stolen funds, hacked funds, contaminated funds in an account and then send to any other account. You can't prevent it. But in Rails, because all the accounts are KYC'd, you know exactly who's the owner of the account. So it doesn't make sense for someone to try and do that.
And just to complement, I think also when you go and buy build from BlackRock is in a closed loop. You cannot freely move the token to whoever wallet you want to. It's always in a closed loop because of that. You don't have the freedom to get your assets and use it to a lending pool, etc. You have to go through a platform, and it's again in a closed loop. So what we want is to bring assets on chain that could be freely used because you have this compliance controls that would allow that. Like for instance, you probably a certain asset that cannot go to a certain jurisdiction would be verified. So we wouldn't be able to transfer an asset from a jurisdiction that don't accept that, or a wallet from a jurisdiction that doesn't accept that.
Okay, all right, understood. So you can't create accounts unless you're KYC'd, and then there are sort of a rules framework which can be applied in terms of transactions, and you've got a permission layer on top. So and who are the what's the consensus mechanism? Who are the validators, or how do transactions get sort of approved and processed?
Yeah. So on the public chain, it's an Ethereum layer 2, so there's a sequencer. And so ultimately, the security of the system is provided by Ethereum itself, right? Because the transactions get rolled up into Ethereum, and then get verified over there. On the permission chain side, it's a different system, because this is another thing that we realize talking to financial institutions and banks. Yeah, a lot of them, like I explained before, they were trying to install internal blockchains, permission blockchains. And then if you start asking them questions, and for example, if you ask, okay, why do you want to install it? They would say, well, because we want to learn how it works. Okay, fine. We want to be on the EVM standard because that's the biggest ecosystem, and we want to make sure that our tokens are compatible with whatever else, so that it can be used in DeFi protocols and so on. Okay, fine. And because we want decentralization. And that point to me was always a bit weird, because why would the bank want decentralization? You could argue that, decentralization because of disaster recovery and high availability, but those problems, they have already been solved in other ways, in Web 2. And so it turns out that the reality is the banks, they don't need decentralization on the blockchain. What they need is to be on the standards, on the correct rails. That's why we named our system Rails, because they want to be on the blockchain rails with the EVM and so on. But they don't really need decentralization. So one of the and by the way, decentralization even in public blockchains, the reason it exists is for censorship resistance, right? So that no one party can just shut down the system or steal funds and so on. And so one of the insights that we had with this was we built Rails in a way that the way it works on the permission side is that each bank can install what we call a Rails node. And this Rails node has no consensus. It's a single node system. That's why is one of the reasons why it's so fast, because it's a single node system that is connected at the back end to a enterprise grade database. Okay, so this is kind of like how every other system works in a bank today. There's an application that is connected to a database. All of this is cloud based. So, there's high availability, there's disaster recovery, there's backups, and all of that stuff. It's compliant with ISO 27001 to SOC 2 Type 2 and so on. So this is easier for banks. And then these nodes, they can connect to one another through what we call a hub. So the hub is yet another blockchain, also permissioned. And we call this a hub and spoke model for those that are a bit more technical. So there's a hub, and then there's many of these Rails nodes. And so what this provides to you is the following. Because a bank has installed this node on-prem, on their own premises, this means that there's privacy by design, okay? Because the data doesn't leave there. The only way that that data leaves that node is if they want to do a token transfer to another bank that has another node. And this goes through this hub. So we developed a new protocol that we call Enigma to allow this to happen with full privacy. So in the end, what you have is this. You have a system which is distributed, let's say. I wouldn't say decentralized because it's not thousands of people around the world. It's only those people that are running, that system, that consortium, or that network. We call that a subnet, right? And they can communicate with one another, but everything has governance, high degrees of governance. It has security, it has privacy, And turns out those are the very things that banks want.
So the earlier version, whatever banks could not achieve, let's say by building their own um on-chain blockchain network on, let's say, a hyperledger fabric, is now you're able to fix this with Rails, by having it in an architecture which is permission private at one level, but at the same time, it allows you to have a, a chain which is across multiple banks. And you mentioned you developed this Enigma protocol, which also allows them to talk to each other. So is that one way of thinking about it? Is this the newer version of what a hyperledger fabric could not deliver for banks?
Exactly that. And we've seen movements into that direction. So the way we see it, right? A bank, there will be thousands or even millions of networks that needs to connect to something for liquidity purposes, for trading purposes, for service purposes. So again, given it this example, we have a bank, 65 million customers. They are tokenizing 1.2, 1.3 million certificates of deposits a day. The client buys those certificate of deposits, and they're struggle with it because they cannot use it for anything. But the bank said, I would allow my clients to port those certificates of deposits over to a public chain in a secure way. So our clients could use that to lend, for borrow lending, to trade, to leverage that certificate of deposit. That would generate more liquidity. And even, we're doing a test with two banks, which is quite interesting because banks are very, they have a strong competitiveness in between each other. But a bank said, well, I would accept a certificate, a bank A would accept a certificate of deposit from a bank B and provide a loan against it to the client of bank A. Because they say, okay, I know the balance sheet of bank B, you know, I would provide a collateralized loan against their certificate of deposit for their respective client. This unlocks a huge potential because think about it. You have products within your bank that are in a silo and you cannot use it. Imagine you have a better rate to borrow in another bank. You cannot move your assets from bank A to bank B seamlessly. And this locks up, opportunities. So imagine you have those assets tokenized and you can port them over to a lending pool of another bank with a better rate, or even to the public to offer lending. So that's what we are unlocking. And again, we will believe that banks will need these two kind of bespoke model systems where they will start tokenizing for efficiency gains, to be on blockchain rails on their own chains, etc. And all of a sudden, if they will be able to offer their clients a way out through the public chains for other services. And I think this unlocks a lot. Fabric, you install, you don't have this connectivity, you're locked. Even Corda, like Corda just recently announced the connection to Solana for that exactly purpose. Corda was a very, to me, Corda is not even a blockchain, but anyway, they've installed in the banks. They're there. They're not. So now they said, okay, you could aggregate liquidity from some of the Corda networks to this. So again, the difference is that we started with this approach from the bottom up. Is a design principle of Rails network, and that becomes really powerful, especially being EVM, because then you can port tokens over and in between chains more easily. It unlocks a huge potential to use, DeFi protocols, landing pools, AMMs, and collateral vaults, and so on. So that's why we're very excited about that.
Okay. Alex, do you want to add on to anything to that? And also, I'd like to ask, so what's the parallel with, let's say, the subnet architecture of the Avalanche chain?
So, I mean, in terms of adding anything to that, I think the thing is, when we were discussing with all of these banks, like I mentioned before, it became clear that they want to be on the EVM standard, right? And I think that is the reason why we chose the EVM standards, because it was a requirement from our clients. And I think that's one of the major differences with some of the other solutions you mentioned. Like Fabric is great for some things, but it's not EVM, right? And so you fall back into that problem of, okay, you can do things, but then it doesn't talk to the rest of the world. The Avalanche, I think Avalanche doesn't even use the name subnet anymore. They changed it recently. They now call it L1. I think I mean, there's some similarities, but there are also lots of differences. The way that we set up our system is, it is completely up to the client to decide if they want to be connected to the public chain or not. In some cases, they don't want to, or they're not ready to. I mean, it can be done with the flick of a button, but in some cases, for example, we are working with the Central Bank of Brazil. I mean, this is very public. We've been working with them for the last 2 years to build the CBDC network in Brazil. Um, and they initially they are not so interested in connecting to the public chain, which is fine. They could be in the future, but at the moment they're not. They want a completely isolated system, and you can understand why, because it's like a question of national security, even, right? It's the money of the country. And so we take this approach of being very flexible with what the client wants, and the system is completely independent of one another, but it is natively connected. So I think this is a major difference in the case of Avalanche. As far as I understand, you have to be connected in some way or another to the P chain and the other chains that they have.
You mentioned that so you guys spoke to multiple banks, and especially in the more recent times, and and everybody wanted an EVM. So is this something that's sort of very well emerging now, that banks want an EVM platform?
Oh, I think it's very. I mean, it's not just now. It's been for the last few years that because it depends on what the reason is why people want blockchain. If the banks want blockchain, like I mentioned before, to be on the correct rails, then of course, because in terms of like interoperability, composability, it would be better to be in the same standards, right? And that is the whole point of it, because the system today that we have, traditional financial system, it works, but it's very clunky, right? Because every bank, every country, they have their own systems. Everything is different, and this is what creates all of this friction that we see. That you send an FX transaction from one country
Uh,
to another, it takes days to arrive. It's because of this friction that exists. And so, if everyone is in the same rails, and if the rails of choice is EVM, and the reason why they choose EVM is, like I said, is the by far the biggest ecosystem. DeFi, came to be. It was invented in EVM. Tokenization was kind of invented
Absolutely.
in EVM. NFTs, they were invented. So all of these things. I know that there are other options today, but still, EVM is the big standard, and is also seen as more, let's say, more enterprise today. It's a little bit more battle tested. It's been around for longer. It's more decentralized. So yeah, I think, and you can see a lot of the other projects, they've been kind of gravitating towards EVM as well. Cardano supports EVM. There's lots of projects that never supported EVM before, that now they say, oh, well, we also have EVM now. Even projects that have nothing to do before with EVM. So I think it's people recognizing that, for better or for worse, EVM became the standard that people are looking for, especially financial institutions today.
Okay. So Marcos, with that sort of context and what you guys are close to, what's your take on sort of a 1 year and 2 year horizon on Ethereum's price?
Yeah, I think Ethereum has proven that, despite of some noise back early this year with the community, and I think Ethereum had a strong support from all L2s. I think it never failed in delivering the upgrades. You've seen from the change from proof of work to proof of stake, and then the changes on the gas fees and so on. So I think it's very clear that Ethereum has a strong community, And with the recent, announcements from Vitalik on the privacy roadmap for Ethereum, and becoming a more kind of even more institutional grade, security layer. I would call security layer. I think the price could go up to $10,000, even more. I don't know. I don't like to make predictions on this. I like to see the utility of the network, and I think this is more important. That would reflect into the price. That's why at Rails, you know, uh, we're trying to bring utility to the network for banks and financial institutions to really use and say, oh my God, this is really good. This fits to my requirements. This delivers the functionalities I need to use to comply, to offer on-chain banking services. And that's where I think the token the token price will be a consequence of it. That's my analogy to Ethereum. If Ethereum managed to deliver what is meant to be. And then again, Vitalik has a very clear view on that, even with this risk 5 approach, where it would be, EVM or risk 5 to improve the performance. I think, the roadmap is clear. So far, over the last few years, they managed to deliver this. Okay. And imagine the phone. I remember I was in a bank. I had to upgrade Windows version X to version Y. Oh my God, it was a nightmare. I had like a 10,000 servers that needs to be upgraded, applications blowing up, not working, etc., etc. Imagine Ethereum over the last like 4 or 5 upgrades, thousands of nodes being validated, millions of transactions, no glimpse, no problem with the network. It continues working, you know, in a single upgrade. So this is it's unheard in the history of computer science and computer engineering. You're upgrading a system when live with millions of people using it, and there's no stop. And again, this in a way, sometimes in the future will reflect on the price. It will. So that's the view I have. The price will be a consequence. The Ethereum
Yeah.
price will be a consequence of this utility, the security that Ethereum is bringing to the ecosystem.
No, absolutely. It's sort of deep, tried, tested, and the liquidity also exists there when you take Ethereum and the EVM ecosystem. When I set out building a decentralized asset management stack, that's what Arna protocol is. It was very evident that it has to be Ethereum first and EVM. If we are to leverage liquidity across multiple chains, if we are to build really a user focused asset management platform which helps create structured products that can help their access to crypto in a very structured way, it has to be have the entire stack:
Yeah.
dexes, liquidity pools, loan markets, um, uh, everything that's needed. Of course, price oracles. So the entire stack needs to be available and robust, and that's what Ethereum and the EVM ecosystem sort of provides. And it's not a surprise why banks would also want to be on EVM as well. Having said that, it's we all know that sort of security and the transparency that sort of is needed for that security also brings up the issue of the challenge of privacy as well. And that's one of the things. I mean, Vitalik spoke about it as well. And it's one of the part of the trilemma that is clearly on the roadmap to be fixed in the next wave of the innovation on blockchain transactions and especially in DeFi. You guys have Enigma protocol, which is designed also to attempt to fix this privacy trilemma. Can you shed some more light on that? So, what exactly is happening out there?
Yeah, so the privacy, the thing about privacy is there are some private chains, right? We know Monero, Zcash or Zcash. So, and even like what I mentioned before, Tornado Cash, it's a way of doing privacy. The problem is that if you do privacy, you are walking on a fine line. Because your system could be used for nefarious purposes, right? Sending funds in a
So
hidden
just
way
just to
to.
kind of differentiate, I think Tornado was sort of not so much privacy. It's more about sort of maintaining anonymity of sorts. Uh, Mixing up sort of identities. So I just bring in that distinction, so that we don't bring that same lens to privacy.
They are actually the same thing, because what happens with Tornado Cash is if you want to send funds from A to B, if
Mm,
you go to the mixer, then people cannot trace back who sent what. And a
correct.
lot of the privacy protocols we're talking about here, they use the same principle. It's like there's a transaction that is sent, and the transaction could have been sent to different participants. You don't know who it was sent to. So it's a similar principle as the mixer, but it
Okay.
is used in a different way. And so a lot of these technologies that are used in all of these different chains, and even Tornado Cash and even Enigma, they use something called zero knowledge, which is a type of cryptography that allows you to prove something without having to give the information about what is it that you're
Yeah.
proving. And so this is what we have implemented too. So Enigma is based on zero knowledge. Of course, it's not exactly the same as Tornado Cash and Monero and so on, but it has some similarity in the principles that are used and the technologies that are applied. A lot of the inspiration for Enigma came from an MIT paper called ZK Ledger, um, and we expanded on it. We made lots of changes. We had several iterations. We tested with clients, and today the system is being implemented in some of our clients. Most notably in the case of the Central Bank of Brazil. And what it allows you to do is it allows, in the permission chain side, it allows participants to send funds, so make payments, and to do DVP, so delivery versus payment. Okay, so that means in the case of the Central Bank of Brazil, for example, they have this bond, this government bond that they want to, they want to sell for cash or for money. And so this is where the DVP comes in. So one of the legs of the transaction is the bond, the other leg of the transaction is the CBDC, and then this atomically is exchanged for one another inside of the Enigma protocol. But anyone that is looking at the blockchain, so say for example, if you have access to the RPC node, or if you have a block explorer, or if you're a validator of the hub, right, this blockchain in the middle,
Mm,
you theoretically you can see everything that happens inside of the blockchain. But if you have Enigma, then you can see that a transaction happened, but you don't know who it was from, you don't know who it was to, you don't know what was inside of the transaction, like was it which token was being transacted, how much of it was it, nothing. Everything is obscured. And the way we do that is by using zero knowledge technology. uh, we have published a paper that explains, for those that are technical, it's available. You can go to our docs.rails.com and you find there at the bottom. This was peer reviewed. And the next step for us on that is we want to apply this technology, the Enigma technology, on the public blockchain, because it was created for the permission, but now we want to apply it to the public. There's lots of challenges because, for example, in the case of the permission chain, usually we set the block times to be between 1 and 5 seconds. On the public chain, we can go as low as 250 milliseconds block time because we
mhm.
use the Orbit stack. And so this then generates some challenges in terms of creating the zero knowledge proofs. The system has to be super efficient, to be able to produce these proofs fast enough so that the block time doesn't become a problem. So there are some things like this we are working on, but the intention is that we're going to make the system available publicly to be used on the Rails public chain.
Okay, so there will be KYC'd users actually, but their transactions will be completely obscured through ZK.
Yeah, exactly. And so there are ways we can do this. You can, for example, connect a Rails node directly onto the public chain, and you can transact via there. But the bottom line is this: even for financial institutions that are transacting on the public chain, there are situations where privacy is required. And so that is where Enigma comes in.
Now, taking this architecture sort of ahead, um, and you mentioned, so let's take the example of Santander. And so an account holder or at Santander who has fiat will be able to directly use their accounts without realizing at the back end what's happening on chain. Can they at some point in the future directly make a deposit into, let's say, one of Arna's structured product vaults, make a USDC or stables deposit into a structured products vault without really sort of realizing that it's all going through that? And is that something which
Yeah.
is possible?
I mean, it is possible. The way, so the vision for that is that if you are a client of Santander, let's take this example, then Santander is going to be managing your private keys, okay? Because you join the system through Santander. And so, and like for the 5 billion people that are not on chain yet, blockchain can be quite daunting, because you have to
Yeah.
have your wallet and this and private key and then bridge assets and then confirm something you don't even understand. So it's too complicated. So the way that we envision this is Santander would control your private keys, and you would use the on-chain protocols through the Santander user interface. So whether it's the mobile app or the web interface, so Santander would select and approve and provide to you ability to use certain DeFi protocols and resources on chain through their apps and through their web interface. And so for the end user, this is how most people would feel comfortable using this, right? Because then you're using your own bank, you're used to it. And so imagine, for example, if you're using your bank application, the mobile app, and then you want to make a loan, and then they will say, okay, you have two options. You can use the Santander built-in loan, and we charge you, I don't know, 5% per year, or you can use this other one, which is a blockchain based one, and the charge is 4% per year, right? And it doesn't matter for you, just press a button in the app and it happens. So this is the vision that we have, because this connection from the blockchain to the end client of the bank needs to be as seamless as possible.
Okay, and the different protocols or markets that the users can access through that would need to be whitelisted by Santander.
Yeah, because think about it, in the end of the day, the client is the client of Santander. We're not trying to
Mm,
steal the client from Santander. We are trying
mm,
to help Santander provide a better service for their own clients
mm.
with new products and also generate new use cases for
So
Santander
I'll just
itself.
ask there. So then the bank is going to become the gatekeeper again for DeFi protocols. Then, um,
Yeah, I mean, so the vision we always had since the beginning is this: we want the two systems to coexist. By the
mm,
way, people can also join Rails without a bank. They can. There's a system in place already. You go to the Rails portal, and then you link your bank to your account, and then you don't have. Then your keys are managed in your MetaMask. You can use Rails through MetaMask in this way, but this is
uh-huh,
not for everyone. You need to be a little bit more tech savvy for that. But the vision that we had set since the beginning of Parfin and Rails has always been that we want the two systems to coexist. We want the blockchain crypto world to exist, and we want the
um,
traditional financial system to exist. Because the best way to improve things and the lives of people is through competition, right? And so if you live in a country where there's, let's say, a dictator and he's freezing your bank account, it's good to have an alternative, which is crypto. And likewise, if people that are running crypto start to do stupid decisions, then it's good to have a competition from the traditional financial world. Maybe they are faster, they are more trustworthy, they are easier to use. That is the standard that we need to beat if you want to convert people from one to another.
mhm. Marcos, your take?
Yeah, and again, in the way I see it, imagine the following: you have your apartment, your house, in a tokenized format, like the
Mm,
title of your house, and then all of a sudden you say, okay, I have my house as a token. I will port over to a lending pool to borrow money against it. What if this, you know, lending pool gets hacked? I will lose my
yeah.
house. Come on, how does it work? So then the client will say, okay, I will have my token, custodied by a bank, and I want to borrow money against it. The bank will say, oh, I have validated these three lending pools, which we check the security, we trust, and by the way, you can use any of those. Then you can get your house and say, okay, I'll lend part of it, I'll borrow money against it. Similarly to your financial instruments, stocks, bonds, certificate of deposits, and so on, that could say, okay, I have all those assets. Hey, bank, please, I want to borrow money against it. There's this lending pool that you're supporting. I will transfer the tokens over and borrow money against it. That's one example. So they will kind of feel more secure by going that route. Obviously, there will be more savvy, people that to say, no, I want to have the tokens with me, and I want to, effectively lend out into a lending pool that I trust, that I know, etc. But remember, right? If you have a security, a tokenized security, this is it needs to be custodied by a qualified custodian. So it's very unlikely that jurisdictions will say, okay, take a tokenized stock, bring it to your, your MetaMask, and use it freely. It doesn't fit to the existing regulatory framework. It might be that in the future, people say, "Wow, Rails has established a framework where without disclosing the information, you can guarantee that that particular wallet is at certain jurisdiction, it's backed by a bank, and by the way, you can transfer tokens over, even security tokens." Now that's the kind of the infrastructure we're building now. I think the journey that we're building will start with this hybrid world, but in the future, if you have, again, regulated banking services, a bank say this lending pool is provided by bank A, and I accept those type of tokens. So whatever you deposit those tokens, I will lend you money against those tokens without
Uh-huh.
further KYC, without further risky credit risk score. You just say this is lending pool provided by bank A.
Mm.
Please, I accept those tokens. You lend money. You allocate your token here. I will lend you money out, and that's the future we're seeing. And that will generate a lot of competitiveness.
Yeah.
In the banking world.
And how are you thinking about addressing sort of cross jurisdiction or cross border issues? I can understand within, let's say, Brazil, you've got a central bank, you've got all the operating banks, and it's operating within the framework. The laws are already set. Now, let's say if we have to transact with banks in Singapore here, so how are you thinking about that?
Yeah, we have, as part of, we've done a work with JP Morgan Kinexis last year, and they even published a report. And again, for your audience that is interested, to have a look, Google it, Kinexis Epic Report. And there, what we've done, we have tokenized funds, and those funds were distributed through from the RTAs, registered transfer agents, to multiple banks. As part of this, we built on-chain suitability verification to address exactly that, saying, oh, this fund can be bought by this or can be transferred by this wallet, verifying if the client is either a qualified professional or the jurisdiction itself, which means that there's already using, we have used the Ethereum attestation services to make sure that, again, that wallet could be eligible to buy that particular token. And again, which may include suitability verifications, such as it's a professional investor, is not, or the risk appetite for the particular investor, including, again, jurisdiction. That's already live, and I think this will be a requirement. Again, as an investor, I can open an account in a bank in US and buy stocks. Okay, there are some jurisdictions. What you cannot do is that the U.S. banks come to Brazil to offer, U.S. stocks locally without being licensed, without being registered. But let's say I have an account, it's being validated, and all of a sudden I said, okay, I I, I'm onboarding with you. You're validating my wallet. I want to buy this
Mm.
stock. You would be allowed to. Obviously, we'll see if there's further regulation to happen. But I think this is a way we're seeing going forward.
What do you think is the sort of biggest misconception that TradFi has about DeFi and blockchain?
Yeah, I think one of the biggest misconceptions that blockchain will solve all the problems of the banks. So try to find think, oh, once I'm on blockchain, problems are solved. It's not necessarily that. Another one is, um, there's some misconception. People say, oh, it's a ledger. No, it's a transaction ledger. It's not an accounting ledger. This is a big misconception. People believe that they will replace their accounting system by a blockchain because it's a ledger,
Uh-huh.
right? It's not. It's a transaction. It's a very good transaction ledger. You can track an asset move from A to B to B to C and so on. And again, this is transaction. It doesn't have anything to do with accounting. Generating postings to a balance sheet or to generating a regulatory report. And I think this is kind of sometimes a misconception. Um, and and again, I think that is slowly changing, of course, because people are testing, are using it for proof of concept projects and so on. So this is kind of busy. The other one is uh, the world will become more complex in the sense that there will be multiple networks, there will be interconnectivity, interoperability, etc. And again, um, that's why we want to try to simplify this. Um, it's not easy to use still.
Mm.
The user experience of it's still not good, right? Let's let's take this for granted. If you're not savvy enough,
Mm.
connect your MetaMask. If you use a bridge incorrectly, you lose the money. It's gone. It's gone. Listen, if you press a button and your token's out, don't please send back to me, forget about it, it's over. So this I think will be a challenge as well for the use of the blockchains in a mass adoption. I mean, really billions of people. That's why we're trying to bring these primitives to
Uh,
Rails, seamlessly allow those banks to use it and to take these misconceptions out and again slowly it's a journey. It's not something we're looking we're positioning ourselves and we're managing to convert already those big clients. But it's a new what we call financial markets infrastructure that we're setting up. And again, it takes ages.
mm.
Think about the internet, right? Back in the day, bank said, "Oh no, forget about the internet." And then all of a sudden, a new bank creates an internet banking portal. Branches were over. Banks realized, "Oh my God, I can't serve the same client with an internet service. Let's shut down these branches because it's costing me a fortune. People go, they are robbed, etc." And then they create the first service just to consult their balances, clients consulting their balance. And then clients could pay. Then clients could invest. Then clients could, do whatever online.
Given all these misconceptions that have sort of existed, and also in many forms sort of distrust around an open ledger technology that is permissionless, decentralized. Um, Alex, how was it sort of getting the first? How difficult was it getting the first bank on board?
Yeah, there's a funny story that when the first time I explained Rails to a major bank, that I will not say who it was, but I remember that in the meeting people were laughing. They were saying it makes no sense. Why would anyone want to use this? And it's not gonna work and so on. But then slowly that same bank now became a client, and other banks became clients because they realized, those things that I mentioned in the beginning is like they want to be in the blockchain rails. It's the future. No one wants to be left behind. This has accelerated a lot now with the new administration in the US, where there's been changes happening in the regulatory bodies in the US that makes the environment much better for anything to do with blockchain. So banks are now coming to us and saying, "Oh my gosh, I realize now that I'm behind the curve. Help me." And then they start to see that what we have built with Rails fits exactly to their needs because it has all the aspects, like I mentioned before, that what they're looking for. So it was difficult. I think the Central Bank of Brazil was like a major project that was very publicized in Latin America, especially, and helped us a lot. And they also did all this work to explain why it's necessary, why it's important, and so on. The work that we did with JP Morgan, Marcos mentioned, the EPIC report was also, I think, very important. JP Morgan, you see that all these banks that are, let's say, more, tech savvy, they tend to be leading the pack, right? And JP Morgan for sure is one of those. They had their own blockchain for a long time now that used to be called Onyx, and now it's called
Yeah.
Kinexis. So they've been setting all the standards.
Their
And
CEO
so
makes contradictory noises, however.
yeah, I remember that it was forbidden to have to buy Bitcoin, and I think at some point Jamie Dimon said that if someone buys Bitcoin, they will be fired. I don't know. I never worked in JP Morgan. I don't know how much truth there is in those things, but the fact is that despite all of those things, the bank's been investing in the technology for sure in
Mm.
blockchain, right? And there's many evidences around the world about this. Go Quorum. I mean, there's many examples. So I think what we will see is that other banks, JP Morgan, like I said, led the pack, but other banks are gonna start to see, especially with the products we are planning to launch in Rails, that oh my gosh, I can either be in and part of this revolution and be ready for the future, or I can be stubborn and be left behind and maybe miss a big opportunity to make more money.
So one final thought. There are all these large financial institutions behind me across the bay. What would be sort of one killer use case, an on-chain killer use case that you would put across to convince financial institutions, skeptical financial institutions, especially to come on chain?
Yeah, I mean, the two things we are very excited about are number one, CBDCs, but this is not for everyone. So we're working with several central banks, in projects to deliver CBDC. But then the other thing is tokenization, especially tokenization of receivables. So commercial receivables, credit card receivables. And the reason why this is exciting is because they tend to pay good yield that we can make available to users on the public chain.
So CBDCs and tokenization, especially of receivables, let's say. So
Receivables.
those are two.
Yes.
And Marcos, what's your one out of these, or is there something else?
I think again, stable coins are dominating. We are dealing with some banks that are planning to launch their own stable coins and process payments. So
Mm.
a very simple case is in a secure way. It's like allow banks to use to process payments within Rails. Yesterday we had a call with a bank that say, you know, if you know if we can use your attestation service on the public chain to verify the recipient of the account before sending the stablecoin, that's perfect, and that's exactly what we're building. And they say, I would use Rails public for that purpose. So that's one example, and then I think the second level would be, okay, I have a no US dollar stablecoin uh, that needs to be converted to a US dollar or a euro, whatever it is, and
Mm.
a bank could provide bank's business is to convert it's to do FX transactions, right? So an AMM that you could deposit a stable coin and convert to any other stable coin. And I think that's also a case that we've been talking to the FX heads of banks, and they say, oh, I want to be part of it, you know. So even JP Morgan in January announced, our next service on Kinexis payments, it will be to on-chain FX services. And again,
Mhm.
we've been testing this with other banks. I think this could be an important shift towards adoption, because again, stable coins are being dominant, are creating a huge momentum now. And I think on the back of that, I think the stable coin for payments is great, but then the second leg will be the FX transactions using stablecoin.
Fascinating conversation, Marcus and Alex. Great to have you on Alpha on Ash. Thank you.
Thank you so much. It was
Excellent.
a pleasure.
Good to be here.
Thanks, sir.